Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And today, in episode 38, once again, we're going back to the basics, intermediate edition. We have back with us by popular demand. I have a few announcements here at the top of the show. We had a listener write into the show. Actually, this person sent two different emails. I won't use last names. Her first name was Rebecca, and I don't have the email saved because I laughed and then deleted them, but she said something to the effect of, please have Credit Union Cowboy back. He sounds hot. And then she sent another email and abbreviated it CUC, which is cuck, and we're going to do a premium subscriber thing going on, which we'll talk more about in the next episode, and no, it's not for any porn-related stuff. But anyway, I thought it was kind of funny because that can mean different things to different people. But anyway, she said he had some useful information. I thought so too. So we're bringing him back today. We have Credit Union Cowboy with us, and before we bring him back onto the show for today's topics, a few quick announcements. Number one, this is a true story. I have a Keurig 2.0, and don't ask me what the fuck the 2.0 is for, but it's a big-ass Keurig. You can brew like pots. You can brew single cups, which is normally what we do. And all of a sudden, it was not working. My wife couldn't get it to work. You plug it into the wall. The thing just starts dripping water. And if you have the little latch open where you put the K-cup in, if you leave it open, it starts spraying everywhere. And I'm like, what the hell's going on? So she asked me to look at it. So I took a look at it. And, of course, I couldn't figure it out. So I went to the University of YouTube. And when I did that, I found a few different videos. Two of them were helpful. I'm pretty sure one of them actually is the reason that I was able to fix it, and the other one wasn't. And you'll see where I'm going with this in a moment. But the first video basically said to go ahead and pretty much boil some water. I'm lazy, so I use the microwave, and put it in there because it's trying to preheat, and in order to trick the preheating mechanism in there into kind of just stepping over that and working, you have to put already hot water into the Keurig. So I did that. The second one said take a bottle of Windex and spray it on the little mini screen that's about 2 inches by 2 inches and wipe it down. I did that too, and somehow after doing both of those, it worked. Why the hell am I talking about this on a personal finance podcast? Because it's a long-winded way of saying thank you to Otis, who bought the show a coffee with the Buy Me a Coffee link that you'll see in the show. It's kind of like a tip. It's kind of like leaving a tip. And if I had the ability to do that on these two different YouTube channels that actually helped me fix the Keurig and saved me probably $150, I would have bought them a coffee and thrown them a tip. So if you're listening to a show, you get some value out of it, you like it, and you want to throw the show a bone, we appreciate it. Feel free to leave us a tip in the form of Buy Me a Coffee. There's a link in the show description about that. We will talk more in the next episode. We have a huge announcement coming up for those that are subscribers to the show, and we're going to be doing some premium stuff, and we'll talk all about that next time. So a little bit of a continued teaser on that, but we are working hard behind the scenes on some stuff for you. So I think you guys will like that one. And let's see here. For the shout-outs today, we have two new countries listening to the show, Norway and, I'm probably going to butcher this, but Tanzania. So thank you to everybody out there and in Norway for listening to the show. Thank you to all of our listeners for listening to and supporting the show. We'll have some additional ways to do that here coming soon. And then the last thing, we got some feedback. So we had somebody write in, and they were giving feedback on the pre-tax versus Roth episode with Cube Crusher and Cold Brew. And there was a comment, we actually went back and forth a little bit. There was a comment that they said we did not include, or our conversation did not include Social Security. And I think what this person was trying to say was that when it comes to Social Security retirement benefits, even if you had all your money in Roth and you took qualified distributions which are tax-free, that you could potentially still have to pay taxes on a portion of your Social Security benefits, especially if you and a spouse were high-income earners and those numbers were fairly large. And that is true, but I actually went back and listened to the episode, so if that person's listening to the show, and I'm pretty sure you are, feel free to go back and check out the episode. We started that on right around minute 17, and then if you go further on through the show, we talk a little bit more about planning considerations, and at the end, we talked about David McKnight and having, balance in your pre-tax account so that your RMDs were equivalent to the standard deduction, and I could go on forever, but it's in there. So check it out. If that's still not clear, please feel free to email the show again, and happy to talk more about it, but we did include that in that show, in my opinion. We didn't go in excruciating detail. We talked about it on other episodes as well, but good point. Thank you for giving us that feedback, but some of that information, believe it or not, is actually in there. Okay, without further ado, let's bring back to the show, second time returning guest. We're going to start calling you Cuck. Credit Union Cowboy.
Thanks, Cashflow King. Yeah, if you start calling me Cuck, I might not be back again, but
All
I
right.
appreciate it.
Well, for all the listeners here, he rushed me. I am a little late today to the recording. I had to go to the gym. We just had a daylight savings time bullshit, so everything is an hour ahead, and I had just got out of the shower. I'm running behind, so I'm actually recording with my shirt off. Don't worry, I'm married. Please don't write the show and say that Cashflow King sounds hot with his shirt off, because trust me, I don't, and I certainly don't look it. But thank you for coming back, and hopefully the listeners will appreciate you coming back on the show today. We have several things we're going to talk about and kind of see how it goes. We sort of had not really a laundry list of topics, but we had several. And after talking after the last show, I think what we've decided to do is pretty much go through what we can. And if we need to do a part two, we do. If we don't, we don't, and kind of go from there. So, all right. So I guess where we'll start today, kind of stemming off to the previous show, for anyone that's just finding us and just tuning in here in episode 38, Back to the Basics Intermediate, please feel free to go back to episodes 36 and 37, where we kicked off this little mini-series, and we did a Back to Basics Beginner Edition in 36, and then in 37, we brought on for the first time, I won't call you, I really want to start calling you Cuck, but I won't. We brought on Credit Union Cowboy, episode 37, and that was our last episode together, so some good information there. So this is going to kind of build on that a little bit, and then we're going to go off on a couple of tangents today. So if you haven't checked those out, please do so. And where we're going to start today is how emergency funds / savings, the amount of savings that somebody might have, can affect their insurances. And we're going to talk about a few different types of insurances today and go through some of that information, which might sound boring at first glance, but hopefully this information will help save you some money over the long term and get a better understanding of what your options are and what might make the most sense for you. This would be a good time for me to go ahead and say that, as always, we don't give any advice on the show. We don't give any tax, legal, or financial advice. We provide information, entertainment, education, if you want to call it that, whatever. This is for your own entertainment. Please always do your own due diligence. Always consult your own professionals based on your own individualized and personal situation. So with that said, we're going to start with auto and homeowners. But I think for most people, auto, we'll spend some time there, is going to be one that comes into play for most people. Now, maybe you don't drive, maybe you live in a big city, maybe you don't have a car, and that's fine. But for a lot of people, the vast majority of listeners, I imagine this would, come into play for them. And so one of the things that I think not a lot of people even think about, or if they do, it's a one-time thought and then they forget about it, are their deductibles. And instead of me just going on forever and ever and ever, I'm going to bring in Credit Union Cowboy here. If you don't mind, can you just explain to the listeners what a deductible is, and then we'll talk about why that's important and how that relates to the emergency fund thing?
Yeah, so at a base level, a deductible is something that you, the policyholder, are going to pay before the insurance kicks in, right, and pays their part. So, in auto, as you're talking about, which is something that is, legally required, right, minimum coverage is required, you're going to have a certain threshold, maybe it's $500, maybe $1,000, whatever, that off the top you're responsible for. Should it be an accident or, whatever, before the insurance company comes in and actually pays anything towards whatever claim there is.
Yep. So, yeah, that's exactly right. And I think that's important, especially if we think about something like collision, which most people are going to have on their vehicles, unless it's a super old vehicle, and we won't go down that road. But let's just assume for the sake of today's conversation that everybody has that, and you get into a fender bender, you're going to be responsible for that first portion. And I think a lot of people, when they're looking at policies, quite frankly, they may not look at them at all, but if they're looking at it, they're saying, okay, how much am I going to be on the hook for? That's my deductible, right? $500, okay, well, that sounds better than $1,000. I don't want to be on the hook for $1,000. I'm okay for being on the hook for $500, so go ahead and give me the one for $500. And the quote-unquote analysis, if you will, stops there. And one of the things that they're probably not thinking about is, well, wait a minute, what if I do have adequate savings? How much would I actually save on what's called my premium? So the premium is the amount of money that you are paying to the insurance company, to the insurer for this coverage. And so, depending on your state and depending on the carrier, and always shop around and do your homework, but oftentimes there can be a fairly significant savings simply going from a $500 deductible on your auto to a $1,000 deductible. And by doing that, you're saying, instead of being on the hook for the first 500 if I get in an accident, I'm going to be on the hook for the first 1,000. And you might say, well, why the hell would I ever do that? Well, I don't know the exact statistic, but I believe it's once every 7 point something years where somebody gets in an accident. If you're saving, say, a couple $100 a year on your auto policy by going from being on the hook for 500 to being on the hook for 1,000, in other words, if you go from a $500 deductible up to 1,000, but you're saving $200 a year, and on average, people get in a wreck every 7 point whatever years. Well, in 2.5 years, you're pretty much to the good, not accounting for time value of money. And so it's a way for you to say, I'm willing as the consumer, as the policyholder, as the insured, to take on a little bit more financial risk in exchange for saving a little bit in premium in terms of how much I have to pay the insurance company. And if something happens and I get in an accident, fine. I'm stuck for the first 1,000. But if it doesn't, then I'm saving money each and every year. And the reason we bring this up here, and I think it's important, is some people can't do that if you don't have $1,000, right? What if you're paycheck to paycheck? And a lot of people are, right? Maybe you don't have your emergency fund built up yet. Maybe you don't have those savings amounts where you need them to be in order to weather a small financial storm like that. And maybe you don't have a choice. Maybe you have to take the 500 or even lower if they offer one deductible because you don't have the savings. But at the same time, if you do that, your premiums are going to be that much higher. And so you're guaranteed to pay more to the insurance company each and every year. So it's a small example, but an important one of how having a little bit of savings and being able and willing to assume a little bit more financial risk in terms of your deductible amounts, if you take it up a little bit, right, within your appetite for, risk, if you will, then you can actually potentially save quite a bit of money in your premiums over a long period of time. And that would be my point there. What do you think?
Yeah, well, I think a couple things. So one, I want to go back just briefly to the last episode, right? We talked about, I think, one of the things that can help. I know I've been in situations where I look at, the car insurance or the auto insurance differently, right? And like you said, everybody's in their own financial situation. So one of the first things that I did, if your concern is cost, generally speaking, a lot of these, they're cheaper to pay if you pay either 6 months at a time or annually. If you do a one-time payment, if you pay monthly, it tends to be more expensive over the course of it. So going back to one of the things we talked about last episodes, and whether you look at this as savings or whatever, I have a separate account that is simply for things car and auto related, and that gets money put into it so that every 6 months the auto insurance is paid in full. And I don't have, kind of the penalty, so to speak, of paying monthly. So that's one thing to do. The other thing is, you're right. You have to look at, where you're at. The $1,000, maybe you can absorb that. Maybe you can, stretch those payments out. Insurance is exactly what it says, right? It's insurance. So if you're not going to be able to come up with more than the $500 worth of deductible, definitely something to look at. But there's an awful lot of ways you can change what you're paying in premiums without necessarily just addressing the deductible. I don't know if you want to go into that a little bit more. We can. I think that's where, again, there are some changes you can make to what your coverage levels are. You mentioned, liability, versus, damage to the car, right? There are different things that maybe you don't want to be, liable. You don't want to be able to be sued for a bunch of money should you get in an accident and injure somebody else and you're determined to be at fault, right? That can be good, but also over time, the value of your vehicle is decreasing, right? So personally for me, I'm in a situation where the vehicle that I have, the value of it is not much, right? So the deductible is kind of immaterial to me from a standpoint of, if I wreck my car, it's more than likely, given how much, it costs to fix a car, it's more than likely going to be totaled or close to that, right? So I don't really need to be putting a bunch of money in there on damage or, windshield replacement or anything like that, because it's not going to save me a bunch of money, right? That car is nearing the end of its useful life. right? That's something that I've looked at, and I have changed coverage over time to impact my premiums. And it's also made me look differently, as my financial situation has changed, and as again, as the car has aged, to look at that deductible that I'm targeting differently as well. Because what I don't want to do is be paying, again, it's insurance. I want to cover my liabilities. But from a standpoint of the car itself, from a replacement factor, I'm not getting, they're going to write me a check based on what the value of the car is if I wreck the car and total it, right? And that's it's not worth it to pay a bunch of money each year. You don't want to be in a scenario where you're paying like more than the car is worth, for the insurance necessarily. Again, each to their own on what they're comfortable with from a liability perspective there.
Okay. So let's take it a step further for a second. So you're saying, if I'm understanding you right, the liability coverage is important because if you're in your car and you kill someone, it doesn't matter what the car is worth. You still killed someone, and they may, their family may come after you or something to that effect, right? It's kind of an extreme example, but the car coverage itself, if the car's not worth much, you don't care as much about that. So you can get into specific numbers if you want to or not, or you can give us a range or not. Just give the listener kind of an idea. Okay, well, maybe let's say you bought the car brand new. What might your coverage look like at that time? And then fast forward to today where you're saying it's not worth as much. How does that look different? And we don't need exact premium numbers, but, like how do you view that and how has that changed over time?
I think I look at it, I try to go line by line. So if I'm looking at it, from an insurer, right, I want to break out the prices. There are, there are different amounts that they'll offer. So it's, 150, 100 to 150,000 or whatever for liability, or two and 250, or $200,000 per passenger, or 300,000. You can set those levels where you want. I think that's, and all of those are drivers, right? So this is a math game. This is, something that actuaries basically put together, right, to determine, okay, with all of these factors and this type of coverage, this is how insurance works, right? That just any type of insurance, that's how it works. That's why they look at, zip code where you live, for auto insurance, and whether it's, you know, garaged or not, right? There's a lot of things that go into it. And I'm saying that if you look at all those things, obviously on a new car, you're going to want some replacement value there should something happen to it. You want to probably, right after you buy one, you might want to lower deductible on that because you've just outlaid this cost, right? But there are other things like gap coverage, which, depending on what it looks like, gap coverage through a lot of times offered through whoever initiates a car loan, right? But that's it too, right? It goes a step further there on, well, did you take out a loan or did you buy the car in cash, right? And that's where it becomes very individualized. But the thing is thinking through all that, and then also shopping around. I firmly believe that that's something that should be done regularly. It's not, in a sense, like, I know we're going to get there later, but like health insurance, right? Most of us are offered that through our employer. You don't get to shop. You can pick a plan, but you can't shop all of the different providers of health insurance, unless you go out on the marketplace and do it solo, which is probably not advantageous to you, right?
Right.
So, but in car insurance, you can. You can change constantly. There are numbers of things that impact your rates, right? We know that with tickets, recency of accidents, all kinds of stuff, right, that factor that in. And I think that that's really important to look around and try to find, coverage to coverage. If everything's the same, who's providing better stuff? Sometimes there's some stuff in there that they'll offer to lower it if you'll put something on your car that lets them basically know if you're speeding a lot, right, or if you have hard stops.
Mm-hmm.
That can decrease. Again, there's a lot of ways, both in the coverage and then the things that the good driver discounts, right, that we hear about. It's not just not being in an accident. It's, do you accelerate quickly? Do you slow down too quickly? And again, those hard stops. That's the stuff that they're looking at as well. Incidentally, credit score factors into
I was going to say that.
auto
Yeah.
insurance as well.
Yep.
Yeah, I think you kind of touched on that in a prior episode, and it's there are a lot of factors that go into it. I think you've got to look through it and look realistically at your financial position, the automobile or automobiles that you are insuring, and what you truly are looking from an insurance perspective for those. What you would get and how much, okay, for my own injuries, how much do I think I would actually want? There's again a lot of things you can adjust. They kind of tend to give you a stock or ask you, hey, does this sound good? But you can go through and adjust nearly everything. Again, there are legal minimums, right, for coverage, but you can go in and adjust a lot of that to make sure that you're not paying, I don't know, 2,500 a year or something for a car that's worth 2,000, right? Like that would be less than ideal to do if you can help it.
Yeah, and a lot of these companies too, a good portion of them just kind of being sort of in the insurance / investment / whatever you want to call it, financial planning space. I don't sell auto or homeowners, but most of the agents and most of these companies, they will pay the agents a fairly large commission on a first year or new policy. And typically subsequent renewals are paid at a lesser amount. That's generally how it works. And that, I think, is one of the reasons why a lot of these companies are so eager for new business to get you in the door, because they know, let's face it, most of us are lazy, right? And we may not want to shop around every year, every 6 months, every 2 years, whatever the time frame is. And so, okay, we can get them sort of, I don't want to say a teaser rate, but we can get them at a particular price point on year one, right? And that kind of gets them in the door. And then over time, just like your fucking cable bill or DirecTV or whatever people are using these days, all of a sudden now, they could be in a situation where that gradually creeps up on you every single year. Now, I happen to know somebody pretty well who owns an insurance agency, and the particular group that he's with, they don't do it that way, surprisingly. They are typically way less than others, but they actually pay their agents, and I don't know how they do this other than it's a volume game, the same on first-year policies as they do on subsequent year policies. And you might be thinking, well, why the hell do I give a shit about what people get paid on these? The point is, to Credit Union Cowboy's point, shop around and don't be afraid to shop around. Sometimes you may be better off with the same carrier, and other times you may not be. I know for me personally, I've changed carriers several times over the years, and there have been times where I've been with the same carrier for several different years. So you just really need to see, what does that look like? And sometimes the differences are substantial. A lot of times they will be. Other times it might be sort of a nominal difference. And then you have to go to, okay, does it make sense for me to have a local agent in my market, right? Or does it make sense for me to have 1-800-GOOD-LUCK to save $10 a year? Well, that's your decision. I don't know. Some people will save the $10 a year and hope they don't get in an accident. The other people say, fuck it. If I have a claim, I have a claim, whatever. So it's going to be different. And then the other thing is, as far as deductibles go, I'll share this because I actually pulled it up for today's podcast. Personally, on my vehicle and on my wife's vehicle, we each have a $1,000 deductible for collision as opposed to $500. I don't have the quote saved from what it was at $500, but I can tell you the premium was higher. Now, there is an option, because I remember asking, to get a higher deductible than $1,000, and I don't remember what it was. It could have been $2,000 or $2,500 or something. But there comes a point where it just doesn't make sense, because the amount of premium that you save, every marginal or incremental deductible that you go up, you're not saving that much more in premium. So another way to say that would be, I save a shit ton going from a $500 deductible to a $1,000 deductible, but I save peanuts if I go from a $1,000 deductible to a $2,000 deductible. So I don't really give a shit about the peanuts. I'm going to go ahead with the $1,000. That's good to go, and I'm fine, all else being equal. So that's personally, one of the things that I look at. And then we haven't really gotten to homeowners yet, but while I'm on the deductible thing, I looked at that, and my deductible is $2,500 on the homeowner's policy, because chances are I am not going to make a claim below that. I had an incident several years ago with the roof where there was a particular section of the roof where they needed to do some work, and I forget, I want to say the cost, it was under $1,000, maybe it was like $800 or something like that. And it's like, yeah, I could file a claim, but then I'm going to have a ding on my claims history. I'm going to have to pay the whole thing anyway, because my deductible was more than that, and that gives the insurance company an excuse to charge me more, which I don't like. So I just paid that out of pocket, kept my receipts, had a warranty on it for a period of time, good to go, didn't file a claim, and it was fine, right? So it's the same type of thing. Now, I could go from a $2,500 deductible all the way up to a $5,000, but again, you have to weigh the pros and cons of that incremental savings, and does it make sense, or are you comfortable at a particular deductible level, right? So that's kind of how I see it. And then the last thing, I might have said that was the last thing, maybe that was the second to last thing. The last thing I'm going to say, going back to the Credit Union Cowboys point about paying your premiums every 1 year, 6 months, whatever the increments are that you do it, as opposed to paying every single month, something we call the modal factor. Same thing is true for life insurance, right? It's a time value of money game. And so he has a separate designated account for that, where he's going to make the payment from those funds that he's accumulated over that period of time, knowing that that bill is coming. And the only addition I want to make to that is the whole credit cards points thing. I know we talked about credit cards last time and, some things along those lines, but for those that, if you're not carrying a balance and you're kind of looking to do the points and miles game and all that kind of stuff, you want to look for typically larger, big ticket expenses on money that you're going to spend anyway, that's probably going to help you hit a certain minimum spend to get a bonus, right? I think I talked about the medical bills that we knew we had coming in. Why not go ahead and get a card and basically get some free points and some free travel out of it for money that we're going to have to spend anyway? Same thing can be true here. I'm not saying you want to open a credit card every year just to pay your auto insurance, but I am saying if that is a fairly large expense for you and you are able, willing, and can afford to pay that all at once, in addition to maybe a couple other big ticket things, it makes it easier and easier to hit some of those minimum spends to get the bonus points. And that way there, you're not going out buying a fucking flat screen TV just to hit it, because that makes no sense, right? This is money that you're going to have to spend anyway.
Unless you want a flat screen TV.
Unless you want a flat screen TV, yeah. And if you want a flat screen TV, then that's all the more reason to go ahead and, check out and see what's out there. And hell, you can get a flat screen TV and a free flight,
Get the card and do it. I want to give a example, because I know the shopping around thing, look, I get it. It's a pain in the ass, right? I don't do it necessarily annually. I probably do it every couple years, but I want to walk through, my story of kind of how that happened, because it was really crazy to me how I got to this point. I had the same insurance more or less from, I think, the time I was, got my license and first started driving, right? I had it through an agent that we knew. Their group I don't know if they got bought or if they just changed who was insuring who they were insuring through. I'm not positive, but it changed. And I'd had a really good experience with that, the prior company, for a long time. And then the agent I knew retired. Everything just kind of went out of whack. I couldn't talk to anybody. And before that, I had always just paid it, right? I just looked at it as there's nothing for me to do. I've got it covered, and I just pay this every 6 months, right? And what I wound up doing was I went out and I started looking around at, different places, different rates. And like you said, you got to be careful, just like you said, cable, anything else. Sometimes there are teaser rates, that kind of get you in, or, it's I mentioned those safety devices, right, that they'll put on your car. And sometimes that's a one-time deal, right? I think they had one in when I was in college for if your GPA was a certain amount or something, right, it would drop it. Yeah, it dropped it that much for the first year. And then it was back to, normal. And what I noticed was that despite the fact that the taxable value of my car, right, was going down, the insurance rates kept going up. And I was not, I wasn't getting speeding tickets. I wasn't in wrecks. I didn't understand that. And I looked around, I found somebody better, and I got with them, and I was with them for a few years. And then in 1 year, there was a massive increase. I mean, it was like 50% increase in the premiums, which is quite a bit, right? Certainly was a problem for me, because, as I said, my goal was to have enough in that account to pay it off, and suddenly I didn't. When I got one of the bills, and I thought, wait a minute, what happened? And I call, and you kind of get the runaround of, well, it's based on many, many factors, and you probably had a speeding ticket. I think I had one that hadn't fallen off yet, or a wreck or something. It was like 6 years old, right? But it hadn't technically fallen off yet. And I was like, well, that's not it. That wouldn't make it go up. That's been there, right? And through a lot of back and forth, what I found out was that their base rate is what had, I think it was more than doubled. So nothing to do with me, nothing to do with the coverage. My coverage hadn't changed, right? Nothing to do with my driving. It had gone up. And so I went back. I was like, okay, well, time to shop again. And I started shopping around some, and I realized that everybody has these incredibly high rates. I say everyone that I was calling. What it was that this was the year, and I don't remember. It's been 5, maybe 6, 7 years ago. But there was a hurricane, okay, that went through Houston, Texas. It hit Houston, Texas, and it essentially just flooded Houston, right? And there was tons of losses in a lot of areas, but one of them being cars, right? Just cars sitting underwater for a couple days. And I I kind of connect the dots there. I'm like, oh well, they lost their ass, right, with all these cars that they've got to pay off. They weren't expecting that. That wasn't in in their math in Texas. It might be in Florida, right, in certain parts, but they hadn't put that into their calculations. So they got to go get that money back because they paid out all these claims, right? And as I'm sitting there with that, I'm like, well, gosh, I guess I'm just screwed paying for this hurricane in Texas, that hurt the insurance company. Now I got to help make them whole again. And with that, I started thinking, and I thought, you know what? There are more local, right? There are farm bureaus. There are different areas or different agencies that are more local that wouldn't be impacted by that. And I went and looked at those prices, and they weren't. They weren't impacted. They were back at what I had been paying. Or actually, one of them, the one I wound up going with, was even more favorable than what I had been paying. So again, worth it to look around and sometimes think through. It blew my mind, initially when I was looking at that number, go, well, how did this go up? Whatever. Why is it across the board? And then once you connect the dots, it's like, well, that makes perfect sense, right? They they lost 100,000 cars or something that they weren't planning on losing, and they had to pay for all of them. Okay, overnight. Obviously, they've got to go make that back. Otherwise, that company probably doesn't exist anymore. I don't know. Do you have enough on your books, right, to cover all of those things that you have? All of your policies in force, just being called in overnight, right? I mean, whether you're life insurance, health insurance, whatever. I mean, the idea is that it's low use and you spread the costs across everybody, right? In that case, they had a lot of use in a very short period of time. So again, just a mindset, a reason to look at things, differently. In my case, it worked out to look locally, and again, got a really good rate, and I've been very, very happy with my coverage since then, with that company.
Good deal. Let's see. Oh, one other thing, this just in general here. Sometimes if you are shopping around, the other company will ask you how much you're paying now, almost like they want to see what the price is they need to beat. And, barring any extreme circumstances like Credit Union Cowboy just outlined, let's just say those losses for that insurance company didn't happen and you just so happen to be shopping around. In my personal opinion, I would not share with the carrier that I'm considering. I would not share with them what I'm currently paying. There's a person asking you, fine. If there's a little field you can type in a box, I'd write none ya for none ya fucking business, because there's a little bit of discretion there, right? And so it's possible that they could give you an even better deal, but if all they have to beat is whatever number you told them, then how incentivized are they? Now, when they come back to you with a number, if it's still higher, all right, then at that point, if you want to give it to them after you've kind of seen how they can go initially, I guess you can make an argument for doing that. But I always would try to hold the cards close to the vest on that one and just see what is the best that you can do, and I'll let you know if it's more competitive than what I'm paying. Now, if they ask you about your coverages, absolutely tell them, because you want to make sure that you're comparing apples to apples. Your deductibles are the same. Your liability coverage amounts are the same. Uninsured and underinsured motorist coverage and collision and all that stuff. You want to make sure that you are looking at an apples-to-apples comparison, that one of them is not, a $500,000 liability coverage and the other one's $100,000, and, one of them you have.
So I think that's a good way to look at it, right? What you're saying, right, is exactly. I totally agree. That's my opinion of how you should look at it. Because if you're focused on the bottom line number, right, that you're paying, if they're focused on that, odds are they can beat it. They're just going to change. I mean, it's simple math, right? They could change out coverages. Unless you are the lowest coverage on everything with the lowest cost provider, they can beat it. They just draw it up differently, and that's the part that'll get you, because you're right. You want to be looking at apples to apples. If they ask for something, tell them what your coverages are, not how much you're paying for it, right? Because the focus should be on, okay, if I picked up this plan exactly as it's written and moved it to you, what would I pay? Not the, well, I can save you $200 on your car insurance. Yeah, if you drop everything by 10 grand, yeah, of
Yeah, if you give
course.
me a shit policy, yeah, fuck them.
Right.
Yeah.
Yeah, if you do that and you make my deductible $7,000, yeah, I was like, yeah, shit, you saved me money. Thanks. Like, no,
Hmm.
they just fucked you. So maybe
Pretty much.
be careful with that. I think most of them know that, but again, we can save you money. Well, sure, but how they do it, you're right, the devil's in the details.
Yeah, and
So
that's one of
definitely
the
make sure you're
things
looking at the right
that they
things.
lead with. Like I know a few people in the insurance business that do auto and homeowners and stuff like that. And every time you hear them talking to somebody or trying to talk to somebody, it's pretty much always the line. Or you familiar with our program and we can save you money. Well, no, yeah, who's going to say no to that, right? Everybody wants to try to save some money, but you have to be careful. So I believe it's called the declarations page. So make sure you take a look at that and you're comparing the two. And then if you really want to get granular, most listeners are probably checked out by now. But if you're with us so far and you really want to get granular, you may even want to ask some questions such as, well, let's say I got into a collision and there were some replacement parts that were needed to repair the vehicle. Are those OEM, original equipment manufacturer parts, or are they aftermarket parts? Some, I don't want to say knockoff, but some equivalent that's really not directly from the manufacturer. And I know I had an incident at one time. I got in a little fender bender and they had to replace the front bumper on my car. And quite frankly, I didn't even think to ask that question before. But luckily for me, and I guess part of it's probably the fact that I do business with the guy that I know, which is usually a good thing. Not always, but in this case it was, because it was an OEM part. They weren't using some other knockoff bumper. Now, they're not going to put a fucking pink bumper on a white car or something like that, but it may or may not be quite up to snuff. So that's another thing that you want to look at, because some companies will try to, or in essence force you to use some sort of potentially somewhat inferior aftermarket part as opposed to the original equipment manufacturer, which would be my personal preference. So that's another thing among, I'm sure, many others that you could look at, but those are some things to be thinking about when you're comparing coverages.
Yeah, if they have, and along those lines, if they have, you can ask them which collision centers, they work with in the area, or repair shops, right? Because sometimes it's very open. They just want you to go get a couple quotes if something happens, and, then go get it done, or one quote, right? Sometimes they'll say, oh, no, you can't, go to place X, right? Or if you do, we're only going to pay what place Y says. Well, what if place Y just, duct tapes your bumper back
Yeah,
on,
Cuck's
right?
Collision, right? You take it to Cuck's Collision and then you're fucked.
Yeah, right. I mean, there's there again a lot of variables to think through. I know we've given the listeners, a lot to think about, and I think everybody's got to look at what matters the most to them. But insurance no matter what type of insurance we're talking about, it's insurance, right? It is for the unexpected and the out of the ordinary, and you've got to, everybody has different risk profiles based on just who they are individually, right? And then also their financial situation. But you will get what you pay for. That is, that's something to look at. You get what you pay for. Yeah, some companies are cheaper, doesn't always mean they're better. Some companies are cheaper, doesn't always mean they're worse, right? But make sure you know what you're getting for the money that you're spending. Again, evaluate it as a relationship, because when you need it, should you need it, and hope you don't, right? We've talked about some, not great scenarios, but when you need it, you really want your insurance, whatever type it is, you want it to be there. You want
Right.
it to help make you whole, as you say, right? That's what you're looking for. So you want to have the appropriate coverage, and you want to be with, you know, somebody that you trust, that you think is going to make that work for you.
Yeah, like last night's, Wendy's double stack where they forgot the bacon for $3. Not a great value. $3 a month to subscribe to this podcast, which we'll talk about in the next episode. Tremendous value. So you always gotta weigh it out, right? Just because it's relatively inexpensive, you may or may not be getting more value than not. I wish they would have just told me that doesn't come with bacon, because then I couldn't remember. They didn't even give me a fucking receipt. I didn't even remember I'm pretty sure it was a bacon double stack, but then I said only cheese and bacon, and they didn't say anything, and then I got it, and it was just only cheese. And anyway, who cares? All right. Can't help myself. I told you I had a late night. All right, let's see. Let's go to, along the same lines, if you're ready to transition, the health insurance stuff.
Okay.
All right, so hit us.
So, I mean, again, going through, right, we've talked about deductibles and premiums. So, premiums, what you're paying up front for your policy, and then deductibles, what you're responsible for before it kicks in. And health insurance, I'll say the same thing that I just said about auto. Any type of insurance, you're going to, get what you pay for. There are a lot of factors that, again, if we assume that a lot of folks have health insurance through their employer, right? your employer has worked with a health insurance company to create an offering of a plan or plans to make available to their employees. And they have, basically kind of went over that with the insurer, picked a plan and said, okay, I want this. It covers these things at this rate. All of those decisions that the employer is making, right, determines what your coverage looks like. So at a base level, there's going to be this coverage costs this much because it offers all the bells and whistles, right? And this one's going to be cheaper because it doesn't cover as much. It's there are legal requirements federally and then states through departments of insurance, just things that have to be covered, mandates in various states. So that's kind of a base level, right? So think of it as if you go to Subway, right? You start with the bread as like the base of your plan, and then they build it up. But each topping, if Subway were to charge you, maybe it's more like a pizza shop, right? Where here's the base, right? And then you pay per topping, right? That's how health insurance plans kind of work. They go up. It's not quite that granular, but that's more or less how it works out. So as that goes up, obviously the cost of the plan goes up, and that's what the employer has to pay to the health insurance company. So the next step that differentiates from that is, okay, let's say it's this plan is going to run somebody $200 a paycheck, right? That's what your employer's paying to, insurance company X is $200 a paycheck per person to be on that plan. The next step is, well, what's the employer coverage, right, versus yours? So a lot of times that's shared by your employer. There's your responsibility and the employer responsibility. They tend to include it in your benefit line. Do you have something like that where you work?
Yeah. Are you talking? So are you talking about like rates in terms of premiums for employees? Or are you talking about? Yeah. Okay. Yes, I do. Mm-hmm.
Yeah. And they'll tell you how much they're paying, putting in towards it versus how much you are.
I can give you an example. Is that what you're asking?
Yeah.
Yeah. So
if you got one.
So yeah, everybody's coverage is different, right? So if you're single, if you're married, if you're covering children or a family, whatever. So based on your coverage amount, but I'm looking here, I pulled it up for mine, and I'm paying about just north of $125 per paycheck, and we're typically paid every couple of weeks, so it averages, it's a little more than that if you go over 26 pays, but on average about $250 per month is what I'm paying for premium. Now, I have a high deductible plan at work. We have the option of a couple different types of high deductible plans, so there's one that's sort of the gold standard, and the other one's kind of like Cucks Collision. It's a little bit below that.
Right.
I think I'm gonna make T-shirts or something. Cucks. I got to run with that. I don't know why. Anyway. Yeah. Sorry. All right. So anyway, I pay like whatever, $250 a month, a little bit more than that. That's my portion as the employee, and then as far as the employer goes, let's see, they're contributing per pay over $500. So they're putting in north of $1,000 on average per month in premium, what they're paying the insurance company. I'm paying about $250. And so my total premium, this is for coverage for myself and for my wife, I'm looking at all in, what's the math here, about $1,260 or so total per month, which is not cheap coverage. But, technically it's a high deductible plan. And I don't know if we're going to get into these next or not, but while I'm talking about it, like our deductible is actually pretty reasonable, in my opinion, relative to some of the quote unquote high deductibles. And it has to be within certain parameters, and I don't have those parameters in front of me. But like on my particular plan, for the two of us, we share a deductible. That deductible amount is $3,400 a year, which means, Go ahead.
Well, no, I was just going to say, so the minimum deductible to be considered a high deductible health plan in 2023 is $3,000 for family.
Okay, perfect.
So you are $400 over that minimum,
which is pretty good because some of them can be significantly more than that. So our deductible, which for the two of us, is $3,400 a year in network and out of network actually, and then after that, the co-insurance amount that steps in, which is the percentage that the insurance company's paying versus the percentage that we would be paying. It's 90% that the insurance company picks up and 10% that we pick up. Every plan's a little different, right? We got the other plan that's a little bit below that where the numbers are different. Instead of a 90-10 in favor of you only paying 10, insurance company pays 90, it's an 80-20. But on that plan, the deductible is quite a bit more. We would have a $5,000 deductible, but we would also save a little bit in premium. And I'm throwing a lot of jargon out here, But essentially, if you just looked at, we'll call them Plan 1 and Plan 2, Gold Star versus Cuck Plan, right? We'll call Cucka Plan, isn't that poop? Yeah. So the Gold Star Plan, I'm just having too much fun. The Gold Star Plan, basically, we're going to pay a little bit more per paycheck in terms of premium, but we're going to get better coverage, and the amount that we have to come up out of pocket, that $3,400, is going to be lower. So we have to come up with $3,400 before the insurance company basically starts kicking in, with a couple of exceptions, on that Gold Star plan. On the other plan, we would pay a little bit less. In fact, I think I have the rate sheet here for comparison purposes. Let me see if I can figure this out, because there's too many fucking columns on here. So yeah, we're at 125 and change. Let me see if I can find it. Okay. And the other one would have been a little over $84 per paycheck. So we're looking at a difference of $250 per month that I'm guaranteed to pay in premium for the Gold Star, versus about $70 a month for the poo-poo plan. And so it's a difference of $80 a month that I'm paying more.
$960, a year.
Am I doing that right? Yeah. $960 more than I'm guaranteed to pay, but at the same time, my deductible is $1,600 less. But when it comes to coinsurance, I'm paying 10% on the Gold Star plan versus 20% on the shit plan, and they're paying 90 versus paying 80. So it's better coinsurance coverage on the Gold Star plan, lower deductible, but I'm paying a little bit more in premium.
Right. So let's talk through, because there's a few things in there that I think are important to understand.
Okay.
Right. At a base level, I think if you're looking, again, we talk about all this, everything's very individualized, right? Do you have any chronic conditions? Do you have, are you regularly going to the chiro or PT or, whatever, right? Whatever it is. And do you have medicines that you fill, and are they expensive, right? All that type of stuff factors in, because when you're looking at it, on a base level, what I think a lot of folks probably do is look and go, well, they're both high deductible plans. And this one, I'm going to save almost $1,000 a year, right? $960 a year. That's wonderful. But when things happen, so the way the deductible works is, I think you said it was $5,000 for that one. So the first $5,000, with very few exceptions, like the things that are covered at 100% automatically, like your annual physical and a couple other things that are just, they're written off immediately. Yeah. And preventative stuff is just done. But aside from that, anything you do, the first 5,000 in that, in the Cuck plan, right? The first 5,000 is all on Cuck, right? That's it. It's 100% what they get. Cuck's responsible for the 5,000, and that's the part. Okay, well, can you afford 5,000 without any insurance kicking in? And then when they do, now from 5,000 to whatever, does it show what the MOOP or the maximum out of pocket is for that plan?
Yeah, so let's see. Max out of pocket on that particular plan in network, which is, now there is a little bit of a difference here, is $10,000 on the Cuck plan, and it's only $7,800 on the Gold Star.
Yeah. So, again, there are maximum out of pockets, the most that you're going to pay for anything that's covered, right? Like, you can't pay more than that. But from 5,000 to 10,000, you are paying the 20%.
Correct.
And that's, so again, 20% of the other $5,000, so 6,000. So, I mean, your total liability there is $6,000, right? And you're saving $960 a year. Now, again, if you're relatively healthy, relatively, young, maybe family, no kids yet, like, okay, I can understand people talking through that. But as I've mentioned this last podcast, everybody's healthy and great right up until the day they're not.
Yeah,
right?
but just real quick, and I don't know if I misunderstood or you misspoke or what, but just for the listener's sake, the 20% of the 5,000, you mentioned 6,000. The max out of pocket is 10. So they're going to pay the first 5,000 100% as the individual up to that 5. Then they're going to pay 20% of the excess until 20% of whatever that number is gets them to the $10,000, right?
Sorry, yeah, I did misspeak there. Yes.
Okay.
But I mean, again, that even increases it more, right?
Yeah, so, it's even worse. Yeah.
So you can be out. So you can be out $10,000, but I guess you'd be paying at a not as quick of a pace, right? Past 5, because you're not paying 100%, like you are up to the 5. But that said, I mean, it is, again, you're getting kind of what you pay for there. And is it worth it? I think what you have to do is look at that and say, is it worth it to save the 960 a year?
Yeah. So
Uh,
go ahead. Sorry.
well, no, I mean, again, it's just, it kind of, I think there's a lot of folks that look at it and go, okay, well, I've got health insurance, and they go for, one of the cheapest plans they can because, okay, I'm insured. Yeah, but you're going to pay for everything. And for the record, the plans may not be exactly the same. Not only could the co-insurance be different, there could be things that are covered on one plan, that aren't covered on another. Again, plans can be built differently, right? There's a
And
load range of things that could be covered or not.
just to put some more numbers to this and some color to this, and I will say personally that one of the first years that we had, I don't remember how many years ago it was, that we had the high deductible plan, there was only one choice, and it was sort of a hybrid between the two, but it was closer to the CUC plan, and we didn't have the Gold Star going on at the time. And so there was a point in time, and I was a little bit healthier back then too, where I went ahead and that was the only option I had, but I still wanted the high deductible over one of the other plans, which we might get into. So I chose that. Now that I had a choice between the two, I decided to go Gold Star route. But just to put some numbers on that standard plan, right? So on the CUC plan that has the $5,000 annual deductible, and then you're going to pay 80/20, so you're going to pay 20% coinsurance after you've met the 5,000 until you hit a maximum out of pocket of 10. So if we do some quick math and say, how much do I have to pay? Like, what will my medical bills have to be for that 20% of whatever that number is to get to that 10,000 total? And the answer is an additional $25,000 of medical expenses. So let's put it this way. If you had 30, which is a lot of money, but I mean, that can add up pretty quickly when it comes to medical expenses. But let's say after all the negotiated discounts and all that bullshit, right, then the net bills, we're talking about 30 grand of medical expenses for a family. The first 5 they're going to pay out of pocket for that deductible up to the 5,000. All right, that leaves us with 25,000 remaining. You're going to pay 20% of that 25,000, which is $5,000, until you hit that maximum out of pocket of 10,000. So I guess where I'm going with this is, in order to get to the max out of pocket at 10,000, you're going to have a total of $30,000 in medical bills, and nobody really knows what's going to happen. But that's something you need to have in the back of your mind, because some people see that and they think, well, no big deal. Like, once I hit my max out of pocket, that's it. That's true. But you have to figure out, what's the likelihood of that happening, which is, a magic trick really to do. I don't know if I'm making any sense with that.
No, I think you are. Like, so when I started, when I first went to work, corporately, and had the health insurance offerings, I had no money and wasn't, there, I was getting paid in magic beans essentially. So, I looked at it from a standpoint of, okay, as much as I can't say, and I think I was paying like, I don't know, $70 or something a paycheck, which was the highest amount, right? For what we called at the time the CDHP. It doesn't quite mean what it used to mean, but that was the non-high deductible plan. And I did that because for no other reason than it had the lowest deductible and lowest maximum out of pocket. And what I was looking at was, I think it was maybe $2,400 or $2,800 or something was the maximum out of pocket for a single, right? And I was looking at it going, that's good, because I can't afford any more than that. Like, I'll struggle to come up with that amount should something happen. And again, like, if you've got use, then you're going to have that anyway, right? Like, if you're doing PT, chiro, medicines, any of the things that we mentioned, right? You're going to hit some of that anyway. So I went that route because I couldn't dream of not, right? And I would hear people talk about, well, I pay $6 a paycheck or something. I'm like, yeah, but if something happens, how are you coming up with 10 grand?
Right.
And I literally had somebody be like, well, I'll just declare medical bankruptcy or something. I was like, oh, okay, I guess that is a strategy.
Care credit, fuckers.
Yeah, not going to be my strategy, but it is a strategy. Those numbers, like that, I just said, the minimum deductible in 2023 is 3,000, right? In 2022, for a family on HDHP, in 2022 it was 2,800, right? Those change, those go up over time. And over time, what happened was I got more stable financially, and also we started offering more of those high deductible plans that were closer to the bottom end of the range. So like you said, your deductible for the family is 3,400. You're only 400
right.
over the minimum.
Right.
Like that's a hell of a good deal, right? Especially if you factor in all the things that you can do with it, like HSAs, et cetera, right? You're not outlaying, a whole lot more probably than something that would be, okay, 2,800 or something,
Yeah,
right?
well,
Just
just to
under
give
that
you some
minimum.
additional numbers here. So there is another plan. There's a couple other plans, but one of the other main plans that's it's offered is a plan that's not a high deductible plan, and the deductibles and premiums are very different. So just to kind of take it full circle here, on a family plan on this other offering that's not a high deductible plan, the family deductible is only $900 a year. And you might think, well, that sounds pretty good. And okay, it does. And then after that, you're only paying 10%. So once again, 90-10 co-insurance. Insurance companies picking up 90, you're paying 10 until you hit on this particular plan. A maximum out of pocket is 7,300. So it's really not much different than the 7,800 on the Gold Star type of plan. But there's some nickel and dime shit along the way. Like every time you go to see primary care, you're getting hit with a copay. Every time you go to see a specialist, you're getting hit with a copay. But the biggest thing with certainty that you're going to pay more, and the reason I bring this up, is your premiums. So the premiums on a plan like that is about $260 per paycheck, which is $520 per month, which is more than double what we're talking about for this high deductible plan. But you're going to pay that with certainty. So I don't want to say it's a balancing act, but again, I know we probably sound like broken records, but it's very much individualized based on what you got going on, both conditions and medical things that you think are sort of planned for that year. I know that sounds weird, but maybe you're planning to start a family. Maybe you're planning to have a surgery. Maybe you're planning for whatever. And so you need to take that into consideration versus things that just happen because, like Credit Union Cowboy says, one day you're healthy, the next day you're not. And you just don't necessarily know when that's going to happen. So there's a lot of variables and things you have to think about. But the point there is premiums way higher, deductible lower, and there's sort of some trade-offs that you need to make some decisions around what works for you. If you don't have an HSA, which you couldn't have with this other plan anyway, but you could have one from previous employment, or if you were on a high deductible plan previously or whatever. If you don't have that and you don't have savings and you really don't have a choice, once again, kind of along the same lines and theme as the auto insurance stuff, you may be forced to pay those higher premiums because you don't have the money to cover a higher deductible, because if you get sick, then you're fucked, right? So
Yeah.
all that stuff plays into it. And I guess where we're going with today's episode in the intermediate section here, and this is going to be part one, I think we have some other stuff we'll cover on a subsequent show, probably a part two, is that if you go back to the basics in the beginner, and you do all the things that we were talking about, again, not advice, just ideas and information, but you take a look at your situation, you're improving your situation and all that, and you start building out emergency savings, it can tremendously help you with other day-to-day decisions that you're going to have in your life, whether it's your auto insurance, your homeowner's insurance, your health insurance, whatever it is, it all has sort of a domino type of effect and almost like a stacking effect where when you have some of those things in place, you actually make your life easier in so many other ways that you're probably not even thinking about.
Yeah.
Because you give
Yeah.
yourself choices.
Agreed. And, I mean, just looking at that plan, right? I mean, like that 900 sounds great. Okay, the deductible kicks in. If you're factoring low, okay, that's awesome. But again, should something happen, boy, that 7,300 is a pretty large maximum out of pocket. I can't recall offhand what you said. Your deductible is 3,400. What's the maximum out of pocket there?
78, 500 more.
I mean, right? So you're saying that it's going to kick in. Basically, you're paying for it to kick in sooner, right? At that 900 mark instead of the 3,400 mark. That's what they're paying for. That's what they're paying more than double for, is for that to kick in early. But again, a lot of changes. And that's the thing where I think some folks look at it, same thing with like car insurance, right? What we were talking about. They look at it for auto and they say, oh, hey, that's a less number. Well, yeah, but right, there might be less coverage, there might be that. Well, in this case, if you're looking at insurance, if you look at it from a standpoint of very risk averse, right? And you were saying, well, okay, let's assume that I'm doing this because in case something catastrophic happens, right? I think you can plug and play numbers of, okay, well, what if I had $2,000, $5,000, $10,000 worth of medical expenses? What would each plan? You just run it through, right? What would it mean to me to be in that scenario? As you said, obviously the lower level plan's not HSA eligible. It may come with something like a PCA, which is a personal care account that some companies offer that they can't offer with high deductible plans, but they offer in place of an HSA for other plans. Where it's seed money, right, to get you towards that. Some will even cover the deductible. They'll give you $900, right, to pay for that. It varies by company. There's, again, a lot of different things they can do with it. But that's where I think you've got to look at that, and then just look at, are you 25, are you 35, are you 45, right? There's different things to look at as you go through there, and then also look at, your history. What did you spend last year medically, and was that an anomaly, or is that something you think is going to happen, or did you have a really healthy year, but at the last 5 years you haven't, you've had a lot of doctor's visits? I think looking at that and trying to get a whole profile of it really helps you make an informed decision of what the best plan is for you. Again, taking your financial situation into account as well. What can you afford on a medical bill? Because they are very expensive. I mean, you mentioned specialists, or if you had to have a surgery or whatever, if that just happens, I mean, again, there's a lot of things that happen regularly, right, in the medical field that are very expensive. I mean, you just one overnight hospital stay, right? I mean, you can really drive up costs in a hurry, and nobody's planning probably to do that. If you are, to your point, if you're planning a surgery or something, yeah, definitely know you know what you're getting into. But even if not, it doesn't take much to hit these numbers. Like you said, the 15,000, 20,000. This sounds astronomical, but it really isn't. I mean, it's a couple $100 just to go see somebody.
Yeah,
Right.
I made a file. I'm looking at this on my phone right now, and this is only going back to 2020, and it looks like I started it in 2014. But anywhere from, let's see, I had these annual numbers, and on the low end, I'm looking at $156.53 in 2019. On the high end, in terms of what I spent, and this is just HSA distribution, so I guess I must have been on a high deductible plan for that long. On the high end was over $4,000, but that year I had some stuff going on, including LASIK. I did use my HSA to pay for LASIK, which is normally not covered by insurance, but they do sometimes offer a discount. It's a whole separate story, and I had some other stuff going on that year. But yeah, there's some years it's literally less than $200. There's a couple years in there where it's between $1,600 and $2,300. And then I had that big year with over 4,000. So yeah, it's helpful to go back and get some averages and take a look at that and what that looks like as you're making your decision. And even looking at the other plan I was talking about with the $900 deductible for the family, I mean, you're looking at premiums alone, you're going to pay $3,000 more that year in premiums. So, it's kind of I don't want to say 6 of one and half a dozen of the other, but you really have to tweak it. And there's a lot of calculators out there, a lot of benefits guides that your employer might send out. And even if you don't have an employer, if you're self-employed or small business owner, there should be some calculators out there available where you can plug in some of those things and see what that looks like.
Yeah, and again, I think just going through, looking at it, and that is something. Look, OE, open enrollment, right? The election period that comes up every year. I think it's worth a quick stop and look at, does does what I had before still make sense, right? Because over time, things do change. Again, I've switched from what we had, what they called the consumer-driven health plan that wasn't a high deductible plan. I've switched from that to an HDHP because the offerings changed. Things made different sense, right? And when I literally ran the numbers on what I could do and put in HSA with the difference, et cetera, and it's like, well, the difference in the slight raise of deductible, I save, right, money on the premiums, and so I just take the money on the premiums that I was getting, and I just throw that all into the HSA.
Right. And that's one thing that I didn't mention, but just I'm glad you mentioned that, because as I'm looking at this breakdown here, I'm also, in addition to those health insurance premiums, I'm contributing to the HSA through payroll, and I'm doing the maximum for the family, which happens to be another almost $260 per paycheck. So that's in addition to the premium, but the difference is that's going into an account that's owned by me, controlled by me, that can be used for those expenses in addition to what the employer gives you every year. So that's an additional deduction that's coming out of your pay. But yeah, that's good.
Yeah. Yeah, and I know we're about to wrap up for today. I think we can do a lot more to talk through the, HSAs and the FSAs in the future, because again, there are advantages there that, tying it to today, help me make that decision. All things being equal, like, yeah, I would have kept the other plan, not the HDHP, but the numbers got close enough, right, that with the advantage of the HSA, it made sense.
Yeah, let's do that, because we are running a little bit long here, and I know there's some other stuff we want to cover. We're going to have to do at least a part 2. We'll probably wrap right here for today's episode, and then we'll pick it up on the next one with different types of tax-advantaged accounts for your healthcare-related expenses. I think that's where we'll start the next one, and there's some additional topics, which I'm not going to mention all of them, but we'll kind of go through those as we go on that show. Does that sound good?
That sounds good.
All right. Well, very good. We will wrap here, episode 38, Back to the Basics, Intermediate, part 1, featuring Credit Union Cowboy. Hopefully, you'll be willing to come back and join us to pick up next time and cover some more stuff.
Oh, old Cuck will be back. Don't worry about it.
Cuck
No,
will be back.
it.
All right.
Thank you for having me again.
Thank you very much. We will see you in the next episode.
Check the mic and make sure it sound right, boys.
I do want to give a shout out to Tanzania. I'm not sure what you called that country, but
I said,
shout
what
out.
did I say Tanzania or something? Let's see.
I think you did.
Let's see.
You,
I had
you
it.
probably
I had it.
lost a listener, but
Tanzania. That's what I said.
yeah, it's Tanzania.
Tanzania. Okay. Well, I learned a new country today. I was actually going to look that up before the show, and I didn't have time. Originally, it was just Norway. They came in hot here at the end, and they have several downloads and listens from Tanzania. So sorry for screwing that up, guys and gals, but thanks for listening to the show. And yeah, that's where is Tanzania?
It's in Africa.
Okay. Awesome.